Welcome back, everybody, to Stocks with Sorfing. Today, I want to talk about the potential AI bubble that the market is currently in, because everyone who invests in the stock market knows that valuations have gotten pretty large recently, and especially in a particular group of 7 companies that sit very close to the top of the S&P 500. Those companies are Nvidia, Apple, Google, Tesla, Amazon, Microsoft, and Meta. As you might know, those are obviously the Magnificent Seven, and they have made up 41.8% of the S&P 500's total return this year, and they sit at about 35% of the entire S&P 500 market cap, which is absolutely insane that 7 companies can make this kind of impact. So today we're going to start out by talking about the supposed AI bubble and the evidence, everything from the sky-high valuations we're seeing to concentration risk, and yes, even the famous circular financing photo. We are going to go over that. Next, we're going to look at some of the counter arguments, because this is a little bit different than the typical dot-com bubble that everyone compares it to. We do have some earnings, and we're going to go over that. Following that, we're going to look at 5 things that I'm doing to potentially mitigate risk, and if we do see this bubble pop, things that will also help our returns not be so negative. And to end the video, we're going to end on a nice little upswing, and we're going to be playing the long-term rebound. If we do see a market crash, that's also a time we can try to make money. So I'm going to go over how I will be doing that if we do see a market crash. So let's get right into it. So the most common sign of a stock market bubble definitely has to be the valuations of some of these high growth AI linked stocks. So let's look at Nvidia here, the AI kingpin, on this discounted cash flow calculator. As you can see, assuming you get 20% growth over the next 10 years, currently a fair value to pay for that is $111. But currently the stock is extremely overpriced. So you're taking on significant risk as the valuation is way above the company's current earnings. And to make this a fair value buy right now, if you want to buy Nvidia in a fair value spot, you need to start assuming upwards of 30% growth a year. Yeah, there you go. About 28% growth. That needs to happen every year for the next 10 years. And that is extremely unlikely. In my opinion, making Nvidia an extremely risky investment at this position. Now, if you mix Nvidia's high valuation with the fact that it's sitting at 7.13% of the entire weight of the S&P 500, that is kind of scary, because if this stock crashes, it will bring down the entire market. And on top of that, you got companies like, Apple, Microsoft, Amazon, none of which are overvalued to the extent of Microsoft. But nonetheless, they are overvalued. Like, if you look at Microsoft right here, you need over 20% or 20% for this to even be within $20 of the fair value share price. If you want true fair value on Microsoft with a little bit of margin of safety, then you're going to want at least 23, 24% returns over the next 10 years, which is absolutely insane to ask for when the market typically will only produce, 7 to 10% a year annually with the S&P 500. And then, you get a couple stocks at the top that can do that. Obviously, that's what drives the return. But if these companies don't hit their 20%, the entire market as a whole will probably drop moving forward, because we've had so many years of outperformance in the S&P 500. In my opinion, it's got to have a down year sooner rather than later, because it needs to return to the mean. Now we're going to take a look at where some of these companies are getting the revenue. So before I get off this screen, remember Nvidia, Microsoft, Amazon, Google, Meta, and Broadcom. Because if we go to this map here, you can see the AI money machine. This is the way that the money has been flowing in this current AI economy, I guess you could call it. As you can see, there's a lot of money just moving between the big players. You got, for example, Nvidia striking deals with OpenAI, and OpenAI is buying, a significant amount of Nvidia GPUs, giving them a pretty big piece of revenue. And then Nvidia turns around and funds OpenAI. So you basically have circular financing going on where, people are paying each other for their services, but this is kind of unhealthy because none of these companies are sort of pulling in new money. Nobody has an AI product that people really want to pay for. Like, OpenAI does not have significant revenue on ChatGPT. I would be very surprised if they do, but they are spending significant amounts of money to Nvidia, and Nvidia is just giving them money to buy more product. Now, I wasn't around for the dot-com bubble, but I guess this is super similar to what Cisco was doing, where Cisco would actually have payment plans that they'd be putting companies on they'd be giving them loans so they could buy more Cisco infrastructure, which is super interesting. So with that being said, let's talk into how this might not really be a bubble. Make no mistake, there are definitely some significant differences between the peak of the dot-com bubble and our current market situation. So let's compare Cisco from the year 2000, the peak of the dot-com bubble, and NVIDIA's latest trailing 12 months. Their annual revenues are Cisco at $18.9 billion and NVIDIA all the way at $110 billion. Cisco had $2.7 billion of profit, while NVIDIA currently has $60 billion in profit, and the margins are a massive differentiator here. Cisco has 14% margins, and NVIDIA has a staggering 50 to 55% margins, which are absolutely insane. Now, if you look at year-over-year revenue growth, Cisco was sitting at 55%, and NVIDIA is currently sitting at 120% to 260%, depending on which one of their previous quarters you're looking at. So NVIDIA's earnings are significantly more real than Cisco's were. For example, back then, Cisco had a PE ratio of 200x. Investors were essentially paying $200 for every $1 of profit Cisco made. And currently, NVIDIA is sitting at a forward PE ratio normally between 35 and 50. So where NVIDIA currently does look expensive, it does not look anywhere near the price that investors were willing to pay for Cisco back in 2000. The next point I want to talk about really has to do with the kind of bubble this is, because we're comparing this to the dot-com bubble, but maybe that isn't the most accurate representation of what's going on. Because I've seen some investors argue that this is more of an industrial bubble, similar to the 19th century railway mania, where companies were laying down rail track, spending tons of money, and getting themselves in significant debt to actually do. But that's infrastructure that has paid off and paid dividends for 50, 60 years now. It's incredible, really. So that would mean that, currently companies are spending trillions of dollars building new infrastructure for AI, such as data centers. But maybe right now, the investment, maybe we are in a bubble. Maybe this will crash, but maybe the investment that has been made won't be lost. Maybe this is really laying the bedrock of future prosperity. Even, if some investors, some companies don't follow along in the process. Now, with that being said, let's hop into 5 things I'm doing to potentially avoid the crash or, lower your potential downside if the market were to draw down. So the first thing I'm doing is I'm really making sure to prioritize my time horizon. If I need money in the short term, 1 to 5 years, it should not be in the stock market or any form of equities or even gold. The biggest risk to short-term savings is being forced to sell at the bottom of a crash. So any money that I think that I'm potentially going to need in the next year or so, I definitely do not have it in the stock market. I have it in a high yield savings account within my portfolio, in my brokerage account, but it is not actively in stocks. Now, for me, my expenses are pretty low, and I don't intend on having any big purchases like a down payment on a house anytime soon. So I am very high in equities, in my personal opinion. But having that cash cushion is definitely still nice if the market goes down, because it will allow us to buy at some very nice prices. As you can see in my public portfolio right here, I still have $49.98 in cash. But I'm going to be looking to put this into stocks pretty soon, because right around the corner of the month, I'm going to add another $100 to this portfolio. So I'm going to have another bit of a cash cushion there with that. The second super important thing that I'm doing right now is I'm really making sure that I'm diversified beyond the AI companies. So as you can see in the public portfolio here, I have Constellation Software, which is a software company, and software companies are super hated on right now, so you can get them at pretty good valuations, but I wouldn't say that it's directly an AI company. And as for MasterCard, they definitely have AI built into the business, especially in the other services part where they do things like fraud detection and cybersecurity. AI can definitely be a big part in that. But once again, it's not the core of its business model. MasterCard isn't out here spending billions of dollars in capex just so they can, build out AI infrastructure. So I think this is pretty good diversification. But honestly, on top of that, I should be looking to add other kinds of diversification. For example, maybe some international stocks through an ETF. I don't have a whole lot of diversification geographically in this portfolio. As you know, Constellation Software is a Canadian company and MasterCard is American. It's really all North American exposure. Something else is I don't have any real estate. I guess I could potentially look to add a REIT because that's a hard asset, and typically hard assets can do pretty well if the economy starts to go down. Obviously, the housing market and real estate is not prone to crashes. It can definitely happen, but it's definitely a different kind of asset I could add. I could even add something like a gold. Gold has had a really excellent year, and it diversifies you against the dollar a little bit since it is more of like a traditional, if the dollar dies currency. And it has had a great year. I think it's up 60% year to date, which is absolutely insane for gold. Actually, let's take a look. We're just going to look at GLD here. This is a gold ETF where you can buy paper gold, I believe. And then we don't have a year to date on here. Let's just look at the 1 year. Yeah, 69%. Gold has had an absolutely insane year. The next thing that I'm doing right now especially is I'm focusing on the fundamentals of the companies that I invest in. This is not a time, in my opinion, to go out and be looking for speculative growth stories. I've had a couple of those sort of, cross my Twitter feed or cross my Blossom feed, and I've looked into them because, they are interesting. They always are, and they're super fun to look at because sometimes the numbers can be absolutely staggering. Up like 100%, 70%, sometimes even like 200% a year if you look at some stuff. It's stocks like Open Door, for Canadian side, stuff like Kraken Robotics. They're super fun stocks, but it's not the time to be looking for speculative growth stories. We need to focus on fundamentals. A super important metric to look for here is free cash flow. Free cash flow is the money left over after a company pays for its operations and capital assets, and it's essentially essential for weathering a downturn. So both these companies, both Constellation Software and MasterCard, absolutely have insane free cash flow, as both of them are super asset light. Constellation Software is a software company. They don't own really anything that depreciates. It's just people and companies paying them for their software every year. You make the software, that's the only expense. After that, it just generates free cash flow. So Constellation Software is really good for that. And MasterCard as well is super great at generating free cash flow, as it is super asset light, and it's just, fees every time someone taps. That's straight profit. They don't got to do any sort of maintenance on that. There's no depreciation. It is just straight fees and services, which are tremendous for free cash flow. So this is a super important metric as well, because if we have a downturn in companies, it'll be harder for them to take out debt. They need to have strong balance sheets to potentially weather whatever is going to happen. So this is super important. I cannot stress it enough. But this is also a good time to remind everyone, but nothing you hear in this video is stock advice. This is me sharing my own personal opinions for entertainment purposes only. The fourth thing I'm doing is building a defensive cash cushion, and I try to have non-correlated assets. So earlier we talked about buying gold, and that's a great example here because you want to hold some assets that do not move in lockstep with the stock market. For example, gold is seen as a defensive asset. A lot of the time when the market drops, gold is actually, it doesn't move at all, or it can go slightly up. Now, gold can also be panic sold if the market were to crash like crazy, but it's also something that people would start to buy if they were losing faith in a lot of the system, which is something that can happen when the stock market crashes significantly. Now, having cash as well is also not a bad thing, and I'm definitely not against having it, as I have some right now. Obviously, over the long term, you are losing, and I think it's smart to stick to a certain percent of your portfolio in cash during times like this, but if you can contribute more and keep your cash, I think you should definitely still be dollar cost averaging along the entire way. But you want to have stuff like that. Something else you can look at is stocks like Waste Connections and Waste Management. I think they haven't done too good this year. Let's take a look at Waste Management here. Now, this is a super interesting company. I personally do not hold it anywhere just because I don't love the valuation. Okay, it's up 7% this year. Not bad. The PE ratio is typically pretty high. If I can find it on here. Oh, yeah, 34. It's not that bad. Let's see what Waste Connections is. Waste Connections is sitting at 71, so it's significantly higher. But these are stocks that they're super like defensive, and the revenue is very guaranteed because the garbage truck that comes every morning is, if you're unemployed, you're putting it out, and if you're employed, you're putting it out. They're always going to have business, and a lot of the time the contracts are with the municipality, and the municipality doesn't want these companies to be unprofitable, but they also don't want them to grow too quickly and make their prices too high for the people that the municipality serves. So oftentimes their profit is fixed to a certain percent gain every single year. So you won't destroy the market, but in a downturn, you could still do pretty good with something like this as the revenue growth is pretty stable. That goes a lot as well with stocks like, for example, Fortis. It's a utility stock in Canada. Then they just kind of do like natural gas to houses and stuff. They're typically pretty defensive. They're not going to destroy the market, but you're not going to lose a ton of money in it either. So these are some non-correlated assets that I think are pretty interesting. Personally, at some point, I think I'm going to add Waste Connections to this portfolio. We'll see what happens because I don't think it's a massive outperformer, but it could definitely be a nice stock to have that would hold the portfolio a little bit more stable if times got more turbulent. The final thing I'm doing here, and I think by far the most important, is you really need to be long-term minded. You need to be thinking about the long term. It doesn't matter really, to be honest, what happens in 2026. If the stock market crashes in 2026, that's okay, because we're going to be sitting here on Stock Swiss Surfing. We're going to be buying equities, and over the next decade, to be honest with you, as long as you buy high-quality individual companies, or you buy a good ETF like VOO or QQQ or something like that, I think at the end of the day here, in 10 years, you're going to be making money. So it's important to remember that, and dollar cost averaging is also great. Sometimes it's better just not to look at the stock price. Just log in, do your buys, set up auto buy, and just kind of continue with your life. Obviously, if you're on here watching this video, you kind of obsess over stocks a little like myself. You're looking at the apps a lot. You're constantly reading financials. You're trying to learn new metrics to better understand the market and different companies. But at the end of the day, sometimes it's best just to buy, sit, and forget. So the final segment of this video I want to do is playing the rebound. And honestly, I kind of covered a little bit of it, but if the stock market crashes, similar to how it did back in April, something that I did, if you can't pick individual companies that you 100% feel confident in, it doesn't hurt just to buy an overall market ETF like VOO. Now, this is not financial advice by any means, but back in April, the market crashed, right? I was buying some individuals, but a lot of what I was buying was simply just QQQ, because a lot of companies went from being overvalued to being more fairly valued, and in some cases undervalued. And I thought that they were gonna all of them were going to recover from the dip, but I didn't know what ones would recover more than the others. So I just ended up buying QQQ, and I also didn't want to buy a billion individual names. So I added to my current ones and bought QQQ, and honestly, it did recover, and I did end up selling it later on, fairly recently actually. Just I wanted to make a little more cash, so I sold it. But I think playing ETFs on the rebound is very smart, and it's something that I will do again if the market does crash. But obviously, none of this video is financial advice. I have no idea what I'm talking about. I just like stocks, like talking about stocks, so I post some videos online. And with that being said, I hope you guys enjoyed this video. Leave a like, comment, and if you want to, subscribe. That'd be pretty cool. Also, please rebuttal what I'm saying. Go to the comments and say what I'm wrong about or what I'm right about. I honestly, dude, if you guys say what I'm wrong about, that'll help me improve. And I'll even give you guys some perspective on why the way I think. And, maybe we'll be able to figure it out some way. So we'll figure out who's the best ideas, and we'll all get rich, right? That's the best goal. All right, I'll see you guys later. Take it easy. Peace.